Hi, student. Good day. Today, now we going for chapter 6, Strategic Business Leader, Method of Strategies or Method of Strategic Development. How the strategies are developing, how it is going forward. So, we'll be this topic today. How assess how internal development or business combination of strategic alliance and partnering can be used to achieve a business growth. So there are many business growth, many partnering opportunity like joint venture, business combination, business acquisition. So these strategies we will discuss. Describe the relationship between corporate parent and business units and how corporate parent and can create or destroy value. So business corporate parent, business parent, and subsidiary companies. These F7 student already knows. So they have a background knowledge. We will be discussing. So this chapter will make it easy for you to understand, and with the link with your previous studies. Boston Consulting Group (BCG) and the public sector portfolio matrix model will be discussion topic today. And that these three things we will go through, and we are done with this chapter as well. So method of strategic development, development method, and portfolio analysis. Introduction of this chapter. Already I introduced you about this chapter. Alternative development option. There are many ways in which strategy can be developed. Some of the key methods are explained in this section, like acquisition. So you acquire a company, corporate running business, buy a business, the small business to just to merge with their activity. So this is like a merger or acquisition, buying. So because any business, this is easier for companies to acquire a running business, because if they start from the beginning, it will take time. So a lot of time wastage will be there. But if they running business that they acquire with which is similar to their nature of activities, so it will help them to save time and smooth production process. Acquisition can also be quicker to complete as it's involved an acquisition of the shares target company that can have a high cost and have a significant financial impact. So there are advantages and disadvantages of acquiring a company. So it is a very quick way to grow. There can be a synergies gain. So like both companies get together and they have strong ties, acquire and necessary strategic capabilities, overcome barriers to entry, can choose a target that best for the company portfolio, enhance the reputation. Disadvantages is expensive. Maybe they buy a company, they will buy a higher cost value. They pay extra cost for their experience. Synergies are not automatic, can lead cultural clashes might be there. So their labor cannot might be having a problem, adjustment problem, or some activities which are not compatible with each other. Require good change management. Potential source of synergy. So improve profitability. So then this is again they have explain it further. For sales synergy, when they get together, their synergies can come for sharing database, selling products which are complementary, sharing distributing channel, or these cost synergies are there. So when they combine together, there are a lot of synergies. Their cost saving, their expertise, experience sharing, improve financial position. So if the smaller company, if major company acquire, so they will have improved financial position because their financial problem or selling and excess assets will be they will be not their problem. So there are advantages for existing business they can acquire. So they have improved market position as well. Corporate parenting is also there. Corporate parenting looks like a relationship between head office and the individual business like subsidiaries. This become more important if business follow the route of growth through acquisition. There will be become a good parent of a new subsidiary. So this is the example is well explained and well known to you students. You have done all subsidiaries. They're sharing their goodwill calculation. Their how much percentage of sharing they bring and they take all this advantage, organic growth, advantages and disadvantages, cost, lack of experience of new areas. So these are the organic growth, advantage, disadvantage. Then this is another one is a joint venture. I explain it to you. Joint venture, also called as a abbreviation as a JV, is a collaboration of two parties. One have experience in like a one construction group, one company having the cranes and all machinery and equipments. They joint venture make joint venture with the land providers. So they just have to get together. They share because machinery, equipment, cranes, these all required until the completion of projects. So this is the one of example of a joint venture. It can be another form, other way. Every business they have opportunity of joint venture, or some foreign companies can joint venture with the parent company, local companies. So just to take knowledge of the existing business and their presence in the country. Characteristics and well-structured strategic alliance. Strategic alliance is a very seven characteristics of well-structured alliance have been identified. Strategic synergy, positioning opportunity, limited resource availability, less risk, cooperative clarity of purpose, win-win. So JV is always a win-win. Both companies have brighter chances for success. Franchising model, this is like nowadays the brands are a lot of brands are there in fashion, in food, in pharma, everywhere. The brands they give a franchise rights, they give rights to the franchisee to they take royalty, they take other management fees. All these activities they share together. And like school education business, many institutes giving a franchise, schools giving franchise. So there are advantages and disadvantages. Receive initial capital injection, can spread brand quickly, easily to terminate, a good way to test the market. Franchise may provide better local knowledge. Franchisor management can focus on strategic rather than operational issue. Disadvantages: share profit. They have to give royalties. They have a lot of they have requirements. May give access to strategic capabilities. There may be a lack of goal congress. Obviously, there is a loss of control. There may be a lack of consistency across the franchisee. It may be difficult to attract franchises. Franchising mechanism, just go through. This is a steady reading part. Advantage of franchisor as follows. The disadvantages of franchisee. Both parties have advantages and disadvantages. Business partnering. This is again, this is we have done through. This is a JV business we have gone through. Why partnership? JP Morgan, like any US company, can partner with the local company. Portfolio analysis. Too many declining products or services. Few products and services growth potential. Insufficient product. This is a Boston Consulting Group, BCG matrix. This 2 by 2 matrix classified as a business divisions or products according to present market share and the future growth of that market. Growth is seen the best measure of market activities or attractiveness. Market share is seen as a good indicator competitive strength. BCG model measurement. One of their best is star, cash cow, problem child, and dog. Like in the high relative market share, in high relative market share, and the rate of growth is high. If the high growth and high market share, it become a star. Okay. In the high growth in the market and the relative market share is a low, is a cash cow because they don't have any expenses. They have a low relative market. They have a high market share and low market growth. So this is a cash cow. This is it's a good type of business. It's a high is a rate of growth in the market and relative market share is also a higher side. But here they have a relative market share lower and they have high market growth. It means it's taking consuming the company's resources. It's a dog, is a problem child. Is with the rate of market share is low and high market growth is there. So they have expenses. A lot of expenses are there. They have a problem child. So this scenario, students, you have to practice, which will give you more understanding. Organization would want to have following in balanced portfolio: cash cow, sufficient size and number that can support other products. Stars, sufficient size and other number will provide sufficient cash generation. Problem child that can have a reasonable prospects of becoming future star. No dogs, or if there is any there would need be a good reason for retaining them. BCG decision making aspects, reading part. Ideal progression to illustration below. Then again, they give high to high for high is a star, higher low is a cash cow as a high. I mean higher growth rate and the lower they have market share, market relative market share is a lower side. And then again the high expenses and high market share, they have to pay high cost. Evaluating BCG strategies. BCG strategies are most commonly tested in the exam. Prepare for this. Wait for this strategy. Illustrate analysis skill considering each product. Student, you can make your own self exam tips. If you see some topic is not tested in last 3-4 attempts, so make it sure it is going to test you coming in your exam term. So because this is there is no everywhere you go for exam tips, so they just do the same formula. They apply the same formula. They see the last 3-4 papers and look for whatever topic is not tested. So they just give in a tips. The chances are very high for that tab. And the other tip for you for keep an eye on examiner articles. So if something they have sent in article relating to your exam paper, so there are high chances it is coming in your exam. So this is actually portfolio display. This is a blast. It's a ability to add value. High is a blast, and it's the opportunity to add value. If it is a low, this is Allen territory. Then it is if it is a opportunity to added value is a high value trap with the low ability to value. high ability to value is the heartland, and the high opportunities are there. This is the heartland. So this strategy you have to remember, and you have to practice this example. Heartland business units and blast businesses, value trap businesses. What are these businesses? So remember these examples. We just see these are the those where the appear to have appear many parenting opportunity, but there is a poor fit with the critical success factor. Okay, value of the business. Allen business are those business where the complete mismatch. There should not be a remain part of the corporate portfolio. This is the reason they took give Allen business name. Method of strategic development. This is metrics can be explained introduced what are called edge and heartland business units. This strategy we will discuss in detail in our revision sessions, students. This is chapter summary. Method of strategies. Portfolio analysis, we have done BCG metrics, other metrics are Ashbridge, and the development methods, acquisition, organic growth, JV, franchising, licensing, business partnering. This is the easy bit, and wish you all the best for the exam. So you have done with this chapter, and see you in the next chapter. All the best.